Goodwill. We now come to goodwill in partnership accounts. Two critical areas, one was profit sharing ratio and now goodwill. If these two are mastered, most of partnership is taken care of. So let us understand what is goodwill. What is goodwill? If we take an example, let us take A and B. Two businesses. Both businesses are engaged in the manufacture of shoes. Okay. They both use the same kind of machinery, the same kind of material, and therefore their cost of manufacturing is the same. So let us say their cost of manufacturing of each shoe comes to rupees 300. Now when A sells the goods, he takes a margin of say 20% and sells these shoes for 360. B on the other hand has 100% margin, and sells these for 600 rupees. With only so much information in hand, which kind of shoe would you buy? You would usually prefer this shoe with a cost of 360, since everything else appears to be the same. Let us now say that these shoes are called Kolu shoes. And these shoes are actually Reebok shoes. Once these names have been brought in, it is quite possible that many of us would prefer to buy these shoes, these Reebok shoes for 600 rupees instead of the Kolu shoes for 360. That is the effect of goodwill. So what is goodwill? Goodwill may be defined as a good reputation, the good name of a business. This might arise over a period of time because of maybe the managerial expertise, maybe because of the quality of the product, maybe because of its locational advantage. Whatever reason, a business might have established a good reputation, a good name, and that is the value of goodwill. It may also be called a business's profit-making ability. Its ability to generate profits and extra profits in the coming years. Goodwill is just a good name. It doesn't have any physical presence. It is what is called an intangible asset. It is what is called an intangible asset because it doesn't have a physical presence. We cannot touch, see or feel it, but it is there. It exists. And through we cannot raise this asset in our books. In the sense, as per accounting standards, goodwill cannot be brought into the books unless you are actually purchasing goodwill. Now what happens is, in a partnership, suppose there are three partners, A, B and C, and they have established a business with good repute over a period of 20 years. They now admit a new partner, D. If after admission of D, tomorrow they were to sell this business, a large part of the value of the business, money that they will get, will be on account of goodwill, which would be shared by all four of them. Though D has only just come in and has not really helped in building up this goodwill. So what is usually done is, when a new partner is coming in, an estimate, a valuation of goodwill is made, and the partners and the existing partners, their capital accounts are increased in proportion to D who is coming in, so that they get the benefit of goodwill, so that their capital accounts have been increased, and tomorrow if the business is to be liquidated, is to be sold, their capitals reflect a portion of the goodwill that they have helped to create over the last 20 years. So goodwill is generally required to be valued on admission, on retirement or death, or whenever there is a change in the profit sharing ratio. So what is goodwill? Goodwill is the good reputation, a good name of the business, an intangible asset which has some value, but it may be difficult to put a precise value to it. We cannot see this asset, physically feel this asset, and it requires to be valued normally whenever there is a reconstitution of the firm, when there is a change in the profit sharing ratio, or partner is admitted and therefore there is a change, a partner retires and therefore there is a change, or on the death of a partner and therefore a change in the profit sharing ratio.